Okay, quick question. When the government needs money, where do you think it actually gets it? And when a company like Apple wants $10 billion overnight, do they just ask a bank for a giant loan? Nope. They do something way weirder and honestly, way smarter. Today we're breaking down bonds, what a bond is, how bonds work, why governments and companies sell them, and why your grandma's safe bond investment might not be as safe as she thinks. Let's start with something kinda wild. Imagine your buddy Mike comes up to you and says, "Hey, can I borrow 20 bucks? I'll pay you back in a year, and I'll give you an extra 2 bucks for doing me the favor." That's it. That's a bond. A bond is basically an IOU. It's a loan, except instead of borrowing from a bank, a company or government borrows money directly from regular people and investors like you. You give them money now, they promise to pay you back later, plus a little extra called interest. There are 3 things you need to know about every bond ever created. 1. The face value, how much you're lending. 2. The interest rate, or coupon rate, how much extra they pay you. 3. The maturity date, when they pay you back. Back to Mike. You lend him 20 bucks, that's the face value. He pays you back in 1 year, that's the maturity date. He tosses in 2 extra bucks, that's your coupon. Congrats, you just bought a bond. You're basically a tiny bank now. This channel is all about breaking down stuff like this in a way that actually makes sense. No jargon, no boring lecture voice. If that's your kind of thing, hit subscribe and drop a like. It genuinely helps this channel grow. So, why don't governments and companies just go to a bank like normal people do? Because they need way more money than any single bank wants to hand over. We're talking billions. No bank on earth is just casually loaning out $10 billion to one company. So they do something clever. They chop that giant loan into thousands, even millions of tiny pieces. Instead of one lender giving $10 billion, a million lenders each give 10,000. Those tiny pieces are the bonds. When you hear the US government issued bonds, that means they're asking thousands of investors to each lend a little bit. US government bonds are called Treasury bonds, or T-bonds, issued by the US Department of the Treasury. Companies do the same thing, except they're called corporate bonds. And this is where things start to get spicier, because not every company is equally trustworthy. Here's the part that genuinely surprises people, and honestly, I wish someone had explained this to me way earlier in life. Bonds are not all created equal, and they are absolutely not risk-free, even though a lot of people treat them like some magical, safe investment. Think about it. If your reliable friend Mike, who has a steady job and always pays you back, asks to borrow 20 bucks, you're probably fine lending at a low interest rate because you trust him. But if some random guy at a gas station swears he'll pay you back, trust me, bro, you want a lot more interest, or you say no. There's actually a whole industry built around rating how trustworthy a borrower is. Companies like Moody's, S&P, and Fitch give governments and businesses a grade, ranging from super safe all the way down to junk, which is the actual real term used for the riskiest bonds. Bond prices move, they're not locked in stone. If interest rates go up after you bought your bond, its resale value drops. If interest rates go down, your bond's value goes up. So bonds can gain or lose value even before they mature. So let's connect every piece. A bond is a loan. You lend money, they give you a certificate that says the face value, maturity date, and coupon rate. Governments and companies use bonds because it's easier to split a giant loan among thousands of lenders than convince one bank. Every time you hear news about the Fed raising interest rates, that ripples directly into the entire bond market, instantly. Trillions of dollars of value shifts because of decisions made in a meeting room. Bonds affect way more of your life than you'd think. They influence mortgage rates, savings account interest, government funding for roads and schools, and retirement funds packed with bonds because they're more stable than stocks. Next time someone mentions bonds, you're not going to just nod along pretending you understand. You're actually going to get it. That's a loan. That's an IOU. That's a piece of a much bigger financial puzzle that keeps entire countries and companies running. All right, that's bonds, broken all the way down. No boring textbook nonsense involved. Drop a comment telling me what you want explained next. Smash that like button, share this with a friend, and if you're not subscribed yet, hit that button so you don't miss the next one.